Hello and welcome to the Rask Network. What you're about to hear and see is limited to general financial information only. Please be sure to speak to your financial planner or refer to our financial services guide available at rask.com.au/FSG before acting on the information.
Drew, if you could go back in time and you have $100,000 of today's dollars, right? So whatever the equivalent is back in time, $100,000, and you could go back to any 1 year and invest that money, when would it be?
Any 1 year?
Yep. So like you got $100,000 equivalent.
Or it's got to be like the late 80s, early 90s, which I think, is when the likes of Apple and Amazon first started taking off. Maybe I should be thinking that's too short term. I should be thinking back to the 1800s and buying all these companies that are massive now. But I feel like it's the 90s. Plus, the 90s were incredible.
Okay, fair enough. 90s were incredible.
Great music.
Oh, yeah, sure. Yeah.
Great fashion. 90s fashion's come back, so...
Yeah, true it is. True it is. Yeah, I'd probably go the GFC. It's probably the most recent major collapse that I can think of. And the recovery wasn't that long, and there was a pretty crazy bull market straight after it.
Oh, did you have I thought we would have an almanac from Back to the Future, and you could go and pick which stocks you knew were going to... Wasn't that hypothetical?
No, that's hypothetical. You could do something like that if you wanted to, but then that would be too easy because, okay, so you have a time machine. You could go back in time and pick, a stock that you would have bought. Which stock would you have bought?
Apple.
Really?
Yeah.
Okay, sure. Let's see what Apple is up. I'll just run the calculation. And it is up 127,000%.
Winner. There you go.
I feel like something like Altria, but I'll just go, Amazon, you would have left a bit on the table, 196,000% since
1984. So.
Apple is...
Interesting story, though, because both those companies really struggled at various points. So just saying you bought them there doesn't mean you would have held them all the way through either.
Oh, absolutely. No.
Steve Jobs was kicked out, came back, company turned around. Same with Amazon. Who would ever thought that an online bookseller would replace bookshops?
Yeah. Well, I think one of the businesses that's done extremely well over the years, Altria Group, which is a tobacco company.
Tobacco, yeah.
But it's only up 7,000% since 1984. However, it doesn't include all the dividends. It's paid a shed load of dividends along the way. So interesting that you would go Apple. Do you want to guess? We're just going off Google Finance history here, so it's extremely accurate, as everyone can imagine. How much would, and everyone that's listening or watching can do the same exercise in their head, how much would Microsoft stock have gone up since its IPO? I think it IPO'd, I could be very wrong, in like the 84?
300,000%.
Okay, here we go. Well, it IPO'd in 1986. I'll give you a tip. All right, I'll give you a tip. So it IPO'd, according to Google Finance, the one source of truth, 1986 at a price of 10 cents a share. Don't look it up. How much do you reckon it's up?
250,000%.
It's up 400,000%.
What is that, a 400,000 bagger?
Yeah, I don't even know. I don't even want to think about that.
How do you hunt 10 baggers when you get 400,000 from Microsoft?
That's you just got to be. I wasn't even born then. I'm a post Microsoft baby. Anyway, what have you been working on?
Not to brag.
Yeah, just young and chill. What about yourself? What have you been working on?
A bit of everything. It's a short week, so trying to keep up with what's happening in markets. Massive earnings season over in the US. I think there's something like 28% or 30% of companies going to report this week. Mm-hmm. And just doing my part to try and push inflation down.
Oh, really?
Yeah.
Hey, that's very noble of you.
Not spending too much money.
Yeah. Trying to get those interest rates.
Kmart, yep.
Yeah, let's slip right into it then. Yeah, like long duration bonds have come under a bit of stress the last month or so.
Yeah, I think it was always, when we started talking about these with clients, it wasn't a sure thing that interest rates would fall, or bond yields more importantly. So interest rates, everyone's still predicting interest rate cuts this year, but I think I've said on here, without making it a forecast like last year, unless something major happens, interest rates are unlikely to be cut. That doesn't mean bond yields, which is the bond market, can't move just as quickly. And it actually moves more quickly and more short-term focused than probably any other market. So, well, people use it as a predictor of interest rates coming. It doesn't necessarily, it changes every day, like it's a daily trade market. So from memory, I think the bond yield, Aussie 10 years at like 4.5%.
Yep.
So it's up from probably 4.2, 4.3.
Interestingly, though, Dr. Andrew Dermott did expect 3 interest rate cuts last year, and now his alter ego is suggesting maybe it's not going to come down.
1/3 of the Australian Investors podcast, I don't think.
Yeah. So the implied yield curve for, I'm just going off the ASX website, which anyone can access, RBA rate tracker, 4.13% is the implied yield for December 2024, meaning that's probably, one rate cut this year?
What's the yield at the moment? 4.3, 4.4. Yeah.
4.3.
So they say that an implied yield of 4.1% in December means there's going to be a rate cut between then?
Yes.
But it's not that simple. That's the market implying what the RBA might do. Yeah, we know from history the RBA doesn't just tinker and, play around the edges. Oh, we might decrease it just a little bit just because things are okay. That's not how it generally happens. So these things are good in terms of looking towards the future, and generally what you'd say is they expect a continued slowdown in the economy if interest rates are going to fall. And what does that mean for portfolios? I think the story is still there for bonds, and it's barely changed. Regardless of what happens in the short term on bond yields, you're still getting paid that 4.1 or 4.3% on your investment. And any interest rate moves or bond yield moves above or below aren't going to be significant enough to impact that income too much.
Doctor, can you tell me, I'm going to go to Europe next month, and the euro is currently 61.
Yeah.
0.61. Should I buy my euro now or wait?
What sort of, do you have credit cards?
Yeah.
Yeah. I just use credit cards.
Okay.
Debit cards.
So not only does he do economics, he also does personal finance.
With reasonably good banks. Yeah. I think if you're with a good bank that has fairly transparent pricing and doesn't charge extra transaction fees, which I think is the vast majority of them now, I think the days of trying to buy euro or currency in advance are, maybe I'm killing a business model here, but the old travel money cards aren't as relevant as they used to be. I'll get there and one day and I won't be able to spend that money, but you definitely need cash when you're up front.
Yeah, you need to travel with some cash.
Yeah. But I wouldn't be loading up a card.
Pro tip to any business owners or individuals, check out Wise, W-I-S-E, Wise. You can get a physical card and you can get it on your phone. It's wonderful for businesses if you have offshore teams or things like that and you need to convert currencies. Obviously, there's like OFX as well for businesses. But yeah, Wise is not a recommended thing, but it's just a put it on your watch list if you're into bank accounts to use overseas. Interestingly, a family member of mine applied for the first proper credit card in their life. And have a guess, just without knowing anything else, have a guess what Amex was willing to give them straight out of the gate.
15 grand.
Like $47,000.
And it goes up. If you keep paying it off and you go over 47, you get more.
Imagine the interest rate. That'd be ferocious.
You just have to keep paying it off. That's, the lesson. I don't do personal finance, but always where you can, and don't use credit if you can't, always pay off your balance in full on a credit card.
Yeah. There was a question that was sent in from Breathless Anticipation that said, "Hi team, Drew, where can we buy a copy of your book, quote unquote, The Golden Years, Stuffing It Up Made Easy? Looking for a hard copy to keep on the bedside table at night, and Amazon indicates it is out of stock. It must be red hot." Now, I inserted this.
Must be red hot. I don't know. No, I think Amazon might be waiting for their delivery. So I've been told it's so the book's gone public in most places, but it takes a while for it to get to stores. I did see Evan Lucas posted with him and I think it was maybe Tash's book. Yeah, it didn't tag me underneath. Thanks, Evan. So I DM'd him. He's like, "Oh yeah, your book is there." So it's in there. It should be in all the airport bookshops. I know there's some in Dymocks. A publisher reached out to us today. So there are some books at Dymocks, and most, I Googled it before, and most bookshops seem to have some. But someone did reach out on LinkedIn and said they couldn't find it up in Queensland yet. So I think it should be fine now, 2 weeks after it was launched, but it takes some time for those copies to get to bookstores.
Just to confirm here, just want to confirm which one of these is actually your book. The Golden Years, David Bowie. The Golden Years, a 12-step anti-aging plan for a longer ... The Golden Years, the many joys of living a good long life. Or D, The Golden Years, how to plan a happy and financially ...
Happy to plan a happy and financially successful.
Just wanted to make sure, because I people say you look youthful. I thought maybe anti-aging was what you were talking about. So The Golden Years is available. I did see it in the Sydney airport the other day. Happened to message you and Jamie, and it seemed like I was interstate at Sydney airport at exactly the same time. He's like, I'm in Sydney airport. I just saw it. I was thinking, that's weird. Anyway, so that's out.
Is it bad if I'm going through airlines, when I'm traveling, I'm looking for the book?
No.
Is that bad or is that?
Nice. It's good. It shows you're happy with it.
I'm trying to convince my son to take it to show and tell.
Oh, yeah. Well,
it's been a hard no from him.
That'll be a hit, I'm sure, amongst all the kids.
Explaining retirement.
Upcoming event. The ASA event is upcoming in May 2024. If you're in or around Melbourne, you can get your ticket to an investing workshop on a Sunday afternoon, followed by drinks that evening. And you can hear myself. I'll be running the workshop on the Sunday, speaking that night on some mistakes I've made, as well as hear from many other people and have some cocktail drinks and so on. Perfect for the working listener of the Australian Investors Podcast, or people who don't work and just blur Sundays with Mondays. Get along to it. Also, there's the 2-day conference. So there's the Sunday afternoon and the Monday, Tuesday. You can get tickets by following the link in your podcast player. You get a discount if you're a rascal. So go and check that out. Don't forget, you can send in questions to us via the Ask a Question link, which is available in your podcast player or on YouTube. It's also available on any of the Rask websites. It's the one that says Ask a Question, just like the Australian Investors Podcast. And you can also now do it via the Rask community. So we've got a free community for anyone to join, take the conversation your own way, and have a bit of a say. You know, if you bring something up, we're talking about investing for kids, the difference between VDHG and DHHF, both diversified ETFs. That's all happening in the community this week. We're starting to roll that out at Rask. What else is news, mate? You've got earnings season, you've got other stuff. Tell me.
There's some good data came from the Fin Review this week. Super interesting. Tell me more. Well, it was the top performing funds in Australia for the first quarter of this year. And it was a bit kind of surprising. I know we look at portfolios all the time, but you don't really look at it in the context of just a quarter. We do quarterlies, but we're more worried about 12-month returns.
Yep.
So could you guess what was the types of strategies that were near the top?
Let me just do some calculation in my head. What are we doing? So we're doing multi-asset. We're not just picking geography.
No, global shares. Sorry.
Oh, just shares. Okay. I would think maybe. Oh, this is stretching me. I would think maybe emerging markets.
No.
Oh, right.
I'm trying to get into the sounds these days.
Yeah. I like your sound.
It was quite surprising. So, not surprising in terms of growth managers. Growth managers did better. Growth managers generally have companies that are high. You're eating. Owen's eating chocolate live. Growth managers did exceptionally well, but I was surprised at Nick Griffin's Munro Climate Change Leaders Fund.
Lucky, because you almost said something else just then. From eating chocolate, but I know what you.
The Climate Change Leaders Fund was up 34% for the quarter. So that's
wow.
If you've spoken to Nick, he has like 5 areas of interest. Climate's one of them, and this only invests into climate. And I think that was a combination. They were talking about like the combination of not energy, like renewable energy resources, data centers, recycling, all these other things that are all coming together. And it was a massive quarter. But then something like GQG, and this is like, if you think GQG we've spoken about in the past, mega cap, large cap, 24% for the quarter. And then most of those outperform the best micro cap, so Australian smaller companies that were also great, but 15 to 20% for a quarter. So it's like funds with some of the biggest companies in the world are smashing, not smashing, but posting like almost double the returns of what should be considered the faster growing asset class in smaller companies. Yeah.
Well, those mega caps, they just keep on winning, right?
Exactly. The Magnificent Seven. I was talking to the editor, you remember Tan from Advisor, to him before. He was asking me to write an article about concentration risk. And I said, well, we're less concentrated than anyone else, but about the Magnificent Seven. And I went on this tangent of lazy portfolios. Yeah.
What's a lazy portfolio?
I don't know. You taught me about tangents, so every conversation goes in a tangent. There's different definitions, but I just see it as portfolios that don't have any structure and aren't necessarily given the consideration to what the combination of all their assets is actually meaning for the end portfolio and the performance that they have at the other end. Yeah. So it could be, stacked full of active managers, not including global shares, not including bonds, being too narrow, and, or refusing to invest in ETFs. I know there's a whole generation of investors and advisors who don't necessarily feel comfortable with ETFs. So it's those kind of big decisions that are influencing the ultimate outcome. And it's not necessarily, I see that as more of a risk than concentration.
Yeah. Yeah.
Concentration risk has been around forever, but, inefficient portfolios are not being compensated for the risk you take. It's more important in my view.
It's all well and good when they're going up.
Yeah.
Well, it's like the NASDAQ focused portfolios are very heavy. Those Magnificent Seven. I think a little bit of extra diversification is warranted, to be honest.
Yeah.
There was a question that was sent in. This is probably a good jumping off point for us. It's from Mine_Bogled. Hi, guys. Thanks for providing us with an informative and entertaining podcast. I made the unfortunate decision of investing in LGP, in brackets, Little Green Farmer, whatever that is, a few years
ago. Cannabis, one of the cannabis companies.
Oh, of course.
Yeah.
Little Green.
Yeah,
makes sense.
We were born in the 90s, aren't we?
While it increased about 300% initially, I'm now down 70%. What a reversal. I am wanting to sell some of them, which will obviously be at a loss. I'm also looking at selling some of my other shares that have increased in value. But I no longer like the company. I have no other capital gains or losses for this year and was wondering how I could go about making these sales the most tax effective I can. Thanks, and keep up the great work. Well, yeah, the interesting thing is offsetting capital gains and losses, and there are some rules around that, what you can and can't offset. But generally speaking, Drew, how do you approach this with? You have a lot of, because I'd imagine you'd have a lot of clients at Waddle that come to you with an existing portfolio, and there'd be a smattering of wins and losses in those columns.
More winners than losers after the last 15 years.
Naturally, Waddle clients are just winners, let's be honest. But people do tend to trim their losers over time, don't they? Yeah. And they tend to double down on the winners. Hopefully they do. But you would have people come to your, rock up and be like, this is my portfolio, and you would see that. How do you tax effectively think about that? What do you instinctively first go to?
There's probably two different ways to answer it, and two tangents for it, as there always are. And I'm not saying that.
The new tangent. Yeah.
But a lot of clients come to us and they've got a big holding in CSL, because CSL was $2 back in the day and you bought 500 shares in CSL and now it's $300 a share, and they have massive allocations to it. So when we're dealing with that, we see an opportunity when we write a statement of advice to be as upfront and aggressive as possible. If there's bad parts of that, as we were saying before, if there's lazy parts of that portfolio, if there's overlap, if they've got ETFs that are replicating the direct share, all those sort of things, we see that as the opportunity to just go incredibly hard, tell them what we really think.
Yep.
And from there, get an understanding of what level of capital gains they're willing to capital gains tax they're willing to pay each year. So if you've got, $500,000, and it's actually not that, it sounds weird if I say it's not that uncommon, but even at $50,000, if you've got such a level of gain, you can't do that in 1 year. You can't fix it all in 1 year. But it's about, asking the bigger question, which is how much do you want exposed to a single company 10 years from now, and reversing that back into how do you gradually build diversification, and what level of tax are you comfortable paying in the short term. In my head, my accountants always said, paying tax means you're making money. But it is difficult to to kind of justify, particularly when it's something like CSL or CBA that's done incredibly well for so long.
Yeah.
So it is about finding what they're comfortable with. But the other side, if this is a company that you no longer want to hold or you think has the same growth potential as before, remove the tax from it and just focus it solely on an investment decision. So many bad investment decisions come from considering tax first rather than just making the investment decision and executing it and dealing with the tax later.
Yeah.
Tax-driven investments where most capital has been lost in, I think, Australia over the decades.
Can you say that again, sorry?
Tax-driven investments is where a lot of the capital has been lost. Most of the, really lost capital in Australia has been through tax-driven investments.
Yeah, so the tax tail wagging the investment dog, so to speak.
And like deferred management fees and that sort of thing.
Yeah. That's interesting. That's really interesting. And I would agree with you on that. It's like most people that listen to the show, even if they're entering retirement or in it, they have a long-term time horizon for the shares side of their portfolio. So it would make sense that time to clean up. And we had a similar comment from Jeremy. I think it was Jeremy. Sorry if I threw you under the bus, Jeremy, in the Rask community about this last week, where he said, he's thinking of cleaning out, getting on board with the core and satellite approach. You mentioned before that a lot of people haven't turned to ETFs, and I find that people are resistive of change, generally speaking, but that is the train which everyone's boarding for the right reasons. And effectively his question was, how do you go about that? And my response is that effectively I've had 3 moments in my investing life where I've just completely washed the decks. I've just cleaned everything else. Probably clean the decks? I don't even know. Clear the decks. Yeah, that'll do. Clean house. Yeah, I sail all the time. So spring clean. What else? Give me more. Anyway.
Starboard.
Yeah. Goes to show how much we know. Turns out, unrelated to this, but you've just sparked an interesting point in my mind. Number of boats listed for sale in Australia at, I think it's at record highs. So there you go.
For sale. I mean, we were down in Mornington Peninsula recently, and I think we talked about this a few weeks ago. The amount of houses going up for sale, I think particularly there, is like incredible.
There's also they're also toying with some other land tax ideas and these types of things. Anyway, what I was saying before about
before you went on this tangent,
investing in general is like, I think it's okay to have those moments in your life when you do kind of clear the decks. I've done it probably 3 times early in my career when I was just experimenting, probably 2 or 3 years in, probably 3 years in. Then later in life, probably about 5 to 10 years in, because I was realizing how much ETFs were taking over and I wanted to just simplify into really high quality companies and ETFs. And then again last year, as I just kind of cleared the decks to make way for what is now our investment management business. I didn't want to have any investments. I've got a tiny shareholding in ProMedica still, but I've basically cleared the decks to align myself fully with our investors. And I think that that's okay because it's being done for the right reasons, even if you're incurring tax. At least that's the way I think about it. Speaking of questions, I should do a disclaimer really quickly. We don't know your needs, goals, or objectives. So if you do write in a question, send us a funny name because then we really don't know who you are. And also, you'll get an award if you get the funniest name on the show every week. Could also just be creative. Doesn't have to be funny. Who likes to laugh? Am I right? So get it in. And if you ask your question and it appears on the show, you will get a copy of Drew's new book, The Golden Years, Secrets to Anti-Aging.
What are you saying?
Anyway, we don't. If you do want personalised advice, speak to a financial planner like, say, Drew here, or anyone that you can verify on the MoneySmart website. moneysmart.gov.au has a list of financial advisors and also their license number and any of their particular qualifications, so things that they can give advice in. I'm going to jump to a question. Speaking of scams, Scam or Sovereign SOS wrote in and said, my friend wants to invest with a group that claim to be working, quote unquote, outside the system to support, quote unquote, the little guys. They go on to say, Drew, there's no AFSL, not registered for GST, and can't find who the company directors are. The business does have an ABN. There's a minimum $50,000 investment with a 20% return. Ooh, they know people who already invest with them and are getting the promised return, including an accountant. Apparently the money is day traded and all the money is held in trust accounts overnight. It screams of scam meets sovereign citizen. Where does one find a list of what to avoid in investing / scam watch for those being preyed upon? There is a scam watch website. It's called scamwatch.gov.au. That's one place. But Drew, what do you think of this? Is it a scam?
I don't want some angry phone calls, but if it smells like a scam and it looks like a scam, it probably is.
Okay.
I mean, it reeks of Madoff. Sorry.
Okay. Yeah. No, so okay, I was going to ask this question. No, we're all right, Drew. We're safe here. So if you were to assume what kind of scam this would be, what kind of scam do you think it would be?
Well, I think when they talk about there being people already invested in getting the promised return of 20%, and from a strategy that what you can see here, if it is trading, maybe they are doing day trading and they're making money. There's no guarantee in that. So if you're getting the same return, it's incredibly unlikely they'd be able to continue to sustain that for a long period of time. Sometimes these things work for a while. So it's either suggesting that more money going in is being used to repay existing investors, and anything that you're doing with transferring your money, you want that to be under the guise of a regulator. That you want an AFSL, you want ASIC to be regulating it, and you want complete transparency. And you can get that. You think people view managed funds as being less transparent, but compared to this, it's very different. You can find out what a managed fund's holding, and they have extensive terms that are submitted to ASIC whenever they're seeking capital. So, there's all these things. 20% returns generally means significantly higher risk. And anything, I know they haven't said guaranteed here, but there's no guarantees at all in markets ever, apart from a government guaranteed term deposit.
Yeah. This reeks of a Ponzi scheme. Yeah. Drew's already, so how does that work? Well, Drew's already invested. So he has his money inside this thing. I put my money in, and then they use my money to fund Drew's return. And Drew thinks he's getting a 20% return. So what does he do? He reinvests it and puts more money in. And then they use that. Then he tells his mate, and then that mate funds my portion, then I tip more money in, and then it just goes on and on and on. Very common, unfortunately.
And Charles Ponzi.
And there's no... Is that true?
I'm pretty sure it's Charles Ponzi.
Okay. This podcast is starting to sound like a Ponzi. So there's no AFSL, so you can check the AFSL on the moneysmart.gov.au website. There's also the asic.gov.au website, which is where you will find not financial advisors, you will find every type of AFSL, so like brokerage platforms, fund managers, custodians, those types of businesses. They'll all be on that website. ASIC, A-S-I-C, regulates finance in Australia, and APRA, A-P-R-A, regulates the banks. But either one of those are good. ATO would be good too. But yeah, if they're not registered for GST, it means they're not earning more than $75,000 as a company. You can't find anything on directors. Well, geez, no AFSL. Head to scamwatch.gov.au. They probably have some tips.
I think the problem with some of these is that Scamwatch requires people to kind of report it. So when you see it, you have to report it. Whereas a lot of these scams are only kind of really hit and closed down by ASIC after some people have already lost money, unfortunately. So whenever you see these things, it's you try and report it or as much as you can.
Yeah.
It's not forward-looking, as in they can't see that it's a scam before.
Yep. So we've got two questions that we can probably lump together as one. Jet Ski Dreamin' says, Thomas would love jet skis. Discount to NTA is seen as a less than ideal position for a listed investment company. From my reading, why is it that the price of an index ETF doesn't seem to ever be compared to the value of its underlying assets? We'll pull apart that jargon in a moment. And then Barry Triggerboof, who's written in a couple of times, says, are there differences in risk between ETF or LIC investment structures? Putting underlying investment philosophies aside, for example, provider bankruptcy, director fraud, etc. Okay, so let's start with Jet Ski Dreamin', who asked about the discount to NTA. So what this basically means is the share price of a listed investment company compared to the value of the investments inside of that company. So the NTA, or net tangible assets. So if the company had a share price of $1 and what was inside it was last valued at $1.50, we would say there's a discount because it's trading at less than the value of the assets inside. And that's not that quantum, but some type of discount is often common.
Yeah.
So why is that? Why do we talk about that with listed investment companies, Drew, versus, say, an ETF?
Well, one's a company, one's a trust. An ETF is structured as a trust. A listed investment company is a company, and the difference there is being a company is closed-end, as in it's not issuing more units, whereas a fund is open-ended and it's constantly issuing more units, which means it's almost, and you add the added benefit, which I'm sure you'll expand on, of market makers, and the way that, so every unit you buy in an ETF is reflected of all the underlying investments in that ETF. If that makes sense. Yeah. So you essentially in a company structure, there's no reason that the I'm even confusing myself here with this. Because there's only a limited number of units available, then it's depending on the supply and demand of those units, the share price can easily trade a different value to the company and how sentiment is. Whereas because units are being created and issued every day, and not necessarily about volume, but because there is a paid counterparty that is there to create and buy and sell those units, the discounts to NDA very rarely occur. That in fact, the entire premise of an ETF is that there is no discount to the ETF, although they can occur, during very short periods of time. You can potentially buy a unit in an ETF during a stressful event that is slightly higher or lower than what the net tangible asset value would be, but it's incredibly rare.
Okay.
I confused myself in that one.
Thank you for the detailed response. I did try and look up the WAM Capital. WAM Wilson Asset Management, started by Jeff Wilson. Shout out to Jeff. He's on Twitter these days. So here's how I describe it, is that a LIC, listed investment company, is a company that's limited by shares. So that's where the limited, if you ever see that, LTD in a company's name, limited by shares, basically means that they're not able to just constantly give more shares to the newest investor. Instead, you've got to buy the shares from an existing investor.
Yeah.
So if Drew Limited is a LIC and I wanted to trade shares with you, the listener of this podcast, or all the other listeners, basically what would happen is I'd have to buy them from you, which can push the share price up and down. But that doesn't necessarily mean that Drew's worth more or less. It just means that the price that we're willing to that we're willing to trade is changing. And so what often happens with a LIC is they often trade at a discount to NTA, or their value of the things inside them, because the things inside of a LIC are often only revalued every so often. That's the first point. The second point is that a company, a listed investment company, can actually have will pay tax, and may actually have to pay tax if it sells some of its investments inside of it.
Yeah,
which is different to a trust, which passes the tax straight back to an end investor. It's both good and bad. And finally, I guess the other thing with an ETF is it can sometimes deviate from the value of the assets inside it, but because it effectively has an unlimited number of units that it can create whenever a new investor comes in, it just creates new units, gives them to you, and then the market maker behind the scenes goes and packages up all of the shares inside the index ETF and hands that to, say, beta shares or
breaks it back up.
Vanguard, yeah.
Supply and demand is always in balance.
Yes, exactly. And you were right. Like in the GFC, we saw some bond ETFs deviate from the share price, deviate from the actual thing inside. And that's why some people will tell you to trade ETFs during the day, so that there's a lot of buying and selling going on. But most of the trading that you see that happens in an ETF is actually happening with a market maker. And so what that means is that there are new units getting created and redeemed. It's typically only during those really tense periods of market dislocation when you're buying from another investor, and that can push the price around a bit.
And generally when the underlying investment isn't as liquid, which bonds are technically over-the-counter products, whereas it would, maybe if you're a microcap ETF, but it's also why microcaps aren't part of ETFs in most cases.
Yeah.
Solid reason.
Yeah. Hybrids are a good example of where you might see in Australia, I think, where you might see some dislocation between the ETF price and the share price. And you saw that during COVID. Some of the credit ETFs, so the like hybrids and that sort of stuff, they did have this period where they went badonk and bounced off the bottom and went straight back up, where if you were trading at the wrong time, the value of your investment may have gone up or down dramatically in an instant because of the market friction at the time. For most parts, it's fine. Just keep an eye on it. As for risks, well, yeah, I mean, the good thing about both LICs and ETFs is what's inside them is a group of companies. Yeah. So, or shares or liquid assets. So you can use either of them, hoping that someone else will come in. And we did actually see a LIC get wound up quite aggressively. It was pretty dodgy. It was run by a pirate from Queensland. And it was then administered, I believe, and I could be wrong about this, but Michael Glennon stepped in, who was a fund manager that stepped in to wind it up. And that happened a couple of years ago. It went through the courts and that type of stuff. And that can happen when the fund manager themselves is no longer able to do the thing that they're supposed to do. So, yeah, there's that. And in the case of an ETF, if it gets wound up, you get your money back.
There's something like, I counted line by line myself. I probably could have used Excel. But something like 95% of LICs trade at a discount. And I think it's only a couple of the Wilson LICs that trade at a premium. Mm-hmm. Which was super interesting. And then the difference between the two would be a LIC is you generally rely, there's manager risk in an ETF, an LIC, in that the listed investment is being run by a fund manager, whereas most ETFs are just tracking a benchmark. So the risk is that benchmark performs poorly. You get the added risk that the manager and the benchmark perform poorly in an LIC.
Yep. Horses for courses, with a LIC. So there's a common misconception, and we talked about this a while ago, that Soul Patts is not a LIC. It's an actual company, an operating company. But there are a lot of reasons why listed investment companies could fulfill a role in someone's portfolio. But for really, if you wanted to invest in all Australian shares or all US shares or whatever, it tends to be the best to use an ETF because they're more liquid. But a lot of retirees and those types of things like listed investment companies, I think that was the Peter Thornhill strategy, Drew, because effectively the dividends can be parked inside the LIC and then paid out gradually over time with franking credits. Whereas with a trust or an ETF, it has to be paid out instantly.
So in the pandemic, the Wilson ETFs, I think one or two of them, and the AFIX and the Argo has actually maintained their dividends generally, even though all the companies they own cut their dividends significantly. And that's because they had, as a company, they make their own franking credits, and thus, we're able to, therefore, we're able to pay them out consistently rather than in big lumps.
Yes. In a continuation of that, Drew, Cassius Prophetess writes in and says, "Hey, Owen and Drew, love the 2 cents pod." Don't know what he's talking about. Quick question. Between my wife and I and our SMSF, we get heaps of CHESS statements. Is there any point filing these away? There's no transaction dollar values recorded, so no good for use in cost-based calculations. Is it just for Die Hard 4.0 doomsday scenarios as proof of ownership? Thanks. For those of you that haven't seen Die Hard 4.0, that's the one where Bruce Willis there's like some sort of fire sale and some rogue programmers take over the planet, basically, and he drives a cop car into a helicopter.
That's how it always ends.
So basically like a financial meltdown. Yeah.
No one owns anything, like probably Fight Club for those that are old enough as well.
Mm-hmm, yeah, Tyler. Yep, go for it. What do you reckon? Do you need to keep those statements?
No, I mean, generally, your ownership of these shares is recorded on CHESS, not via a piece of paper. You can turn up with that piece of paper anyway, but it's actually the number on there that's most relevant, and that's all recorded by and maintained by your broker. You can opt out of these, though. So generally, they send you an update on your holdings if something changed each month. You can opt out, and I'd just be going to your share registries, ComputerShare, Link, Boardroom, Atomic, updating and opting out of those because you can download them if you need them, and most of this will go directly to your account via a data feed anyway. So adds very little value and just a big waste of paper.
Yeah, there was a bit of an issue with the ASX requiring the brokers and that to send them, but that's changed a little bit recently. The trees have thanked us for that. You can actually, through most brokers, like I know Pearler, who's a sponsor of our finance podcast, full disclosure, they allow you to select the email option in there, but a lot of the share registries like Link, ComputerShare, Boardroom, etc., allow you to select email preferences so you can save the paper. You also want to go to the share registry and update your dividend and your bank account details too if you want to do that. Share registries are a horrible thing to try and work with because the system's built back before the internet came about. So basically what you want to do is you want to create an account with your share registry, so Link, Boardroom, etc. if you're trading a lot of shares. Typically all of, say, like the BetaShares range of ETFs, BetaShares sponsor of one of our podcasts, or the Global X range or the Vanguard range, all of those have the same share registry. So you can create one account, and if you're in multiple ETFs, you can manage them all from the same account, just as an FYI. Premier Earthly Conundrums writes in, I would like to know if there is any financial product you know of that could give good term deposit style interest rates but allow rapid access for sudden changes in the share market. The Black Swan term deposit for the serious long-term share investor, they say. Obviously, there would have to be some foregone interest in the event of a rapid withdrawal. But the ability to draw funds quickly into a brokerage account to invest is something I would value. I also find that my present cash position leaves me continually having to commit to new term deposits, and the inefficiencies of doing that cost me lots of stress and lost interest. More often, the cash sits at low rates in my brokerage account. It's just unrealistic to want to have the cake and eat it too, is it? So, Drew, one quick thing. Many brokerage accounts don't pay interest, and many investment platforms, like that financial advisors use, don't pay interest. And if they do pay interest, it's at a cruddy rate, so you can check that on their provider's website. So what's an investor to do, Drew?
Well, you can't really have your cake and eat it too.
No.
There's always break fees, even with term deposits, and there's waiting periods for those as well. One, I'm always wary of, time in the market. I won't take that tangent today, though. Mm-hmm. But on the other side, something we do quite aggressively, and this is where we think kind of governance and structure of portfolios comes into it, that we have our quarterly review process, which we talk about all the time, and a big part of that is making sure there's enough cash around, whether it's for opportunities or to meet pension payments and expenses and that sort of thing. So what we do, we use platforms widely, but you can link that platform in most cases to an external bank account, Macquarie, for instance, or and then we'd usually have a portion in cash and then a portion in a high yield bank account. So Macquarie has high yield, Rabo, ING, all these companies and many more have high yield bank accounts. That gives you the slight benefit of those like money market rates, but still completely callable, but they are variable rate term deposits. You're never going to be able to get a fixed rate term deposit and accessibility at the same time.
Mm-hmm.
So it's more treating cash as an asset class, not just as cash, I think is.
Yeah. I think there's two differences there, isn't there? There's like the cash that you have for living expenses, and then there's the cash that you have for your portfolio's sake. For me, we use the AAA ETF from BetaShares. Doesn't pay the same amount as a term deposit, just under. But the reason that ETF, I think, has been so darn successful is all it does is it takes your money and puts it in a bank account, basically, and pools it with other investors. But the idea is that if your brokerage account doesn't pay you any interest, you can just invest in AAA and it will pay monthly distributions, and you can sell it at any time. It still has the T+2 clearing for those people that are familiar with that, meaning that if you wanted to cash the money out, it will take you a couple of days. But it has the benefit of always being in your brokerage account, so that then when you're ready to sell some, you can, and then the money's ready to just trade something else. The reality of actually having to do that at 1 or 2 days' notice is pretty slim. Like even the quickest market corrections, like say COVID, didn't take 1 or 2 days. It takes a little bit longer than that typically. So it's that's probably the most elegant solution outside of what Drew was just saying, or just choose a broker that pays you some interest. We've probably got time for 2 more questions. We'll finish with the Godfather, but we'll go now to Bully Bear. And I absolutely know that you'll have so much to add on this one, Drew. So my question for you is from Bully Bear. How can I momentum trade as an additional tool to help me make shorter-term trades 1 week to 6 months? Your advice on the best strategies, software, and or indicators. I'm particularly interested in your indicators for shorter-term trading, Drew.
This is a stitch-up. Yep. I think momentum is incredibly difficult because there's 2 things here. Mean reversion is what's generally driven markets. So things mean revert to their average valuation over time. But momentum can kill even the best mean reversion. Momentum referring to basically investing more into the things that are going up. And it kind of by itself, it's kind of self-perpetuating. If you continue to invest in things that go up, they continue to go up until a point. I know there's some, you're going to go into like RSIs and a few other techniques. It's stochastic measures.
So I'm going to give you a hypothetical, Drew.
I find a better way to manage this, but go ahead.
Just you can go on with the better way to manage it. Just thinking, but if I had to give you like a hard, like there's a false choice. I know because you use many indicators in your relative role. But if I made you choose between, say, I don't know, like a good candlestick pattern or a relative strength indicator, so just a line that goes kind of up and down, which one would you choose to trade?
The relative strength indicator.
Only people that have followed the podcast for a while will get.
Yeah, I'm really big on momentum, but there are so many better ways to play momentum. Just automate it. So you can get factor ETFs now that chase earnings momentum or follow it, but it's not a surefire strategy. It's like an add-on bit to your portfolio. But then in most cases, if you think the way highly active managers work, is that because they're trying to keep up with the benchmark, they're essentially, a lot of them are following momentum at the same time. So you're adding more to the companies that are doing well because you're afraid of being left behind as the market runs. And momentum's only one factor. Momentum works in short periods of time. There's other factors like size, income, valuation.
Right.
That matter just as much.
I think
you need a blend of factors in any really diversified portfolio.
So for anyone that is unsure about why we were laughing before, this question, and no offense to whoever asked it, it's a fair enough question. But this would be like writing into the Australian Vegan Podcast and asking for our favourite slice of beef. Because we do not trade stocks. I probably had a flirt with one at its very early day, and I was probably looking at things like, CFDs and all those types of things. But I just think they're horrible ways, and I think people think that you can quote unquote trade stocks. If you have a systematic process, like a quantitative strategy, I think that's different to using things like charting and that sort of a thing. There's a good follow for Bully Bear here, maybe someone to go and follow if you're not really interested in fundamental or long-term investing, which is what we do here. It's a guy called Nick Raj from The Chartist. You can go and check him out. He's also on Twitter. But in terms of, indicators, we are fundamentally driven in terms of the companies. And then in terms of portfolios, we're trying to be factual or at least, empirical as much as possible rather than using things that you draw on a chart and that sort of a thing. Fair enough question, but it's definitely one that's probably more suited to a more trading style podcast or group. The Godfather, finally. Actually, yes, we'll finish with this one. We might have to get a dad joke from you, though. The Godfather writes in and says, my wife... Oh, he's got dad jokes. My wife and I recently married. Congratulations, Godfather. And just combined all of our savings. Of this, we will portion a juicy amount, around $50,000, to invest. But I'm not sure whether to dollar cost average this or just buy 5 ETFs / blue chips in one go. What do you think? So we can only speak generally, but congrats on your marriage. Long-term investing, why not? Kick it off. Honeymoon period. I would say, Drew, I personally have always said that I would prefer to break it up. I like how they started with blue chips or ETFs to build that core portfolio first rather than going with, say, something a bit more exotic. You can do that in time, but I would say that. And I would also say if this is something that you plan to do together, both of you get involved. Both of you, go and do some research and come back to the drawing board, have a bit of a date night and pick the investments that you're going to buy and do it together. And it's a great way to both get on board and both support each other through that journey. Share some podcast notes and resources. We've got a good beginner's course if that's where you're at, or an intermediate course. They're both free. Go and check those out. Drew, what would you do?
It depends.
Not good.
If you're buying 5 ETFs and they're all Aussie stocks, or they're all global stocks, or they're all stocks, if you're buying 5 blue chips and they're all stocks, then I'd be looking at dollar cost averaging into that. If you're buying 5 ETFs that cover different asset classes, I'd be more comfortable dumping it all in the market at the same time. So if you had some bonds, some infrastructure, but I'd generally be looking to dollar cost average, but not to the point that costs go up significantly. So maybe it's buying 35% of each of the holdings initially, and then 35 and then 30, and probably executing over 12 or 18 months.
Yeah, cool. It's a good question. A lot of people, it all just the true answer is I chuckle when Drew says it depends now. Even if someone in my everyday life says it depends for whatever reason, I just chuckle. But the reality is it does depend, because the $50,000 might be really meaningful to someone, or they might be then investing $5,000 a month on top of that, in which case you'd be like, well, you're probably going to be dollar cost averaging anyway. There's a long-term plan, yada, yada, yada. Whereas if it's a really important amount, you're a new investor, obviously in that situation, we don't know who this person is. In that situation, someone might be inclined to take it slow and to break it up. But I think ETFs, starting the core and build out, is a really good way to do it. Drew, we do have your joke, which will take us off into the sunset in just a moment, but we have to pick who sent in the funniest name or the best name. I like the Scam or Sovereign SOS, who talked about the Ponzi scheme that their friend could be involved in. That's a great question. You have won yourself a value investor program on Rask Education, $499 free of charge to you, sir or ma'am. Also, you might want to share that course with your friend who's in that scheme, shall we say. Everyone else, you can write in to us and you can get in contact with Drew at wattlepartners.com.au. Send him an email and give him your mailing address, because you will get a copy of his new book, Retirement and Anti-Aging, The Golden Years.
I need a new email account.
Drew at wattlepartners.com.au. Let me just say that very
0419.
Yep. And guess the rest. So, Drew, you've got to take yourself into the sunset, mate. What have you got for us? You got your book, your daddy joke book?
I just realised that I've been looking throughout the books so much trying to find a good joke, and then there's a really, really bad one on the front.
Oh, okay. Go for it.
Yeah. So, what's the difference between a bad joke and a dad joke?
Don't know.
The first letter.
Oh. That's actually pretty good. That is actually pretty good, Drew, from the father himself. Well, mate, this has been heaps of fun. Give Drew a score out of 10. Let us know what you think. Get in touch and send your questions in for next week. Every Saturday morning, 7 a.m. on your podcast airways. Thanks, mate. Always a pleasure.
Good to see you.
Thanks for watching this video on the Rask Network. While you're here, don't forget to like and subscribe so you can get videos each and every day on business, finance, investing, and so much more.